Morning. Thank you for joining us for today's coffee talk. My name is Sean O'Brien. Introduced Steve Huntington. Steve, you want to go ahead and introduce yourself?
Yeah, thanks again, everyone, for joining us for the next installment of our Cecil Coffee Talk. My name is Steve Huntington. I'm the Director of Analytics here at Optima FI, previously Quick Analytics. I apologize in advance if I'm slurring my speech a little bit. I had a particularly unfun dental procedure just the other day, and the whole left side of my face is somewhat swollen and very irritated. So I'm going to step out of character and try to talk as little as possible during the webinar today.
All right, Plain Hurt. We love it, Steve. And I'm happy again just to kind of jump back in and join the band here. And I'm more excited to have Paul Allen join us today. Paul's with Saltmarsh and a dear friend of Quick Rate and Optima FI. Paul, you want to go ahead and introduce yourself and tell everyone a little bit about Saltmarsh?
Absolutely. Thank you for having me back. I enjoy these conversations very, very much. My name is Paul Allen. I'm a director in our financial institution group at Saltmarsh, and we have the pleasure of working with banks across the United States. We're a little bit of a bank geek. We love banking and we love bankers. So very, very happy to have a conversation about CECL and model validation with all of you. Thank you for having me.
Awesome. Thank you for joining us today, Paul. And so, as Paul talked about, you can just see again, they have been a tremendous resource and support of the CECL solver. And if you are looking for model validation, is someone you can turn to. Just a reminder of the mission that Quick Rate and Quick Analytics, along with Infusion and Telecredit, now more widely known now as Optima FI, the growth section, a credit risk section, and a balance sheet solutions section. So again, all the same companies, all doing the same work, just with a new name and brand. Okay, just as always, we're here today just to talk a little bit about CECL. Please, throughout the presentation, submit any questions. We'll monitor those as we go. And I think there might already be one. Someone hears an echo. I apologize. Hopefully that's not too bad, but for you. But hopefully, if you have an open mic, maybe close it on your computer or desktop. Again, submit questions through the Q&A or the chat feature. We'll monitor those. We'll send out a link to today's recording and a copy of the slides early next week. And again, we will try to monitor these and see if there's anything else that comes through. Just a reminder, Optima is kicking off an inaugural Insights Exchange. It'll be in October in Boston. Certainly encourage you to join, register and learn more. But we will have Rodney Hood as a keynote speaker, and Yelena Sholataiva, I apologize if I mispronounced that, from the conference board. We'll also have client panels, executive roundtables, a lot of peer networking, along with some fun social activities. So we think it'd be a worthwhile endeavor for you to join us. So we certainly encourage you to register, or if nothing else, click on the link and learn a little bit more. Okay. So, when we have Paul with us, we're going to let him kind of kick it off and give his thoughts or just some current events around CECL modeling. So, Paul, take it away.
Well, thank you. Thank you again for having us. We're continuing to work with banks and listen to the regulatory examiners as well as external auditors and their comments and so forth. I'm glad to say that we've fully, as an industry, moved through the implementation stage. So now CECL is, believe it or not, a normal process, something we do each quarter for most of you. Some of you do it monthly. And so we're going to talk a little bit about what happens now that we are in a quote unquote normal process. We're going to talk about a few things that we're seeing. I will tell you right up front, it is worth your time to go out and read a recent financial institution letter, FIL 15/2026, in which the agencies have taken a look at, and some people say have stepped back a little bit from getting overly involved in model governance and validation. I would say it's not they've stepped back, but Sean, as we've seen regulatory agencies do before, they've said we're not going to micromanage, but we expect you. So it's a shifting of the responsibility. It says right up front that it is directed toward banks 30 billion and above. However, those concepts are applicable as we think of any kind of model we use in the bank. And there is a interesting definition of their view of what constitute a model. So it's about a 12-page document. I encourage you to pull that down and take a look at it. If you look at page 3 on that document, you'll see where they have attempted to differentiate a spreadsheet that you use arithmetic or math to try to estimate something, as opposed to a model in which it uses economic factors, other things. So there is a recognition, I believe, that perhaps not all institutions need to use as complex a model. And so therefore, the management should use a risk assessment approach to determining exactly what they do for risk management. So, I believe, Sean, I think honestly that's going to take some time for all of us to digest and find out exactly what the thought process there and what implication that has. It doesn't change any of the things on this map, on this slide. Management is still responsible to have reasonable and prudent oversight of the model in considering whether it's doing what it says it will do or what you expect it, whether you are mapping, in other words, getting your data into the right areas for the model. We are seeing, quite honestly, continue. All of us are trying to increase our loan demand, and it's very competitive on deposit side. So I think everyone is thinking about new products and new services and new features on a particular account type. And so we are seeing sometimes that when we change or implement a new product and we map it for call report purposes, sometimes we're lumping two things together that have different risk profiles. And so the mapping is really the old question of garbage in, garbage out. Do we know that the right data is getting into the right buckets? And are we putting things that have the same risk profile and risk characteristics together, or are we keeping those separately? So that's been a continued thought process and responsibility. I will point out also in the last 2 years, the Federal Reserve, the FDIC, and the OCC have all expressed concerns about making sure that call report data has integrity and is correct. There's a great concern that regulators use our call reports for so many things for oversight, and so all of the agencies paid a little bit more attention on mapping and controls over call report. And of course, that certainly makes a difference to us when we put data from our call report into a model like CECL Solver or anywhere else that we use it. The last one, I wish I could tell you what we're going to do for the next 12 months or so. Sean, we had some interesting economists at our bank talk this past week. One was a bit more pessimistic and one was a bit more optimistic. If you haven't taken a moment to look at the June 30 results of our industry, we are record highs in terms of profitability. And at the same time, our reserve to total loans has gone down a little bit while some of the credit metrics have gotten worse. So there is a little bit of consternation, if you will, about whether we maybe didn't provision enough, therefore earnings are up, and we might have to catch that up. So as we look forward, we're obviously trying to predict our historical losses and trying to predict those into what type of economic cycle we're moving into. And right now, um, it is, I saw one of the topics on an economic presentation was certain uncertainty. So it is for sure that we will have some uncertainty over the next little while. So we're continuing to hear these three topics top of mind, if you will. What are the controls? What's the risk management around this area? Are you getting your data in correctly into the model? And then what economic factors are you using, and are you prepared to change those as the environment changes? Our next slide, I think.
Before we go to that one,
Yeah,
could you restate the fill that you'd referenced? We had a question on the fill that you referenced.
absolutely. It's FIL 15 2026. FIL 15-2026. And you can get that. You simply Google that and it will take you directly to the FDIC site and you can look at that. It's about a 12-page document. And like I said, it's hard to say, oh, this is exactly what they're trying to do, but they did talk a little bit about how I think it expresses some concern that perhaps they overdid it in trying to get very, very involved in second guessing all the specifics in the model validation. Want to make sure that banks recognize that that is their responsibility. Interestingly enough, they completely carved out AI from the scope of that FIL. So I'm not the smartest guy in the world, but I suspect that we will be getting additional guidance on any model that uses AI in the modeling system and how we will get our hands around that. So right now, they expressly scoped out AI, and they expressly scoped out any worksheets like spreadsheets or something that are simply a mathematical calculation as opposed to considering economic factors or assumptions and so forth like that. So there is certainly a move toward looking at what a bank is doing, what is its risk profile, and is it using a reasonable and prudent method? And then the question is that method a model? If it is it a complicated model? Therefore, you look at risk assessment and you look at how much you have to do to make sure that that model is reasonably operating as it's intended to operate.
If I could jump in for just 1 second, Paul, on the AI front, very timely that you mentioned that, just because of the fact it was just yesterday, we got a question in from a customer who's dealing with an audit currently and was asked that exact question about is CECL Solver tool using AI in any meaningful way? And the answer to that question is no. So right now, our tool, CECL Solver, does not utilize AI for any functions within the modeling or math at all.
And I will tell you that part of the background behind that AI and that scope carve out is that many of the cores are embedding AI within their service lines and so forth. So there is a concern that do we actually know whether AI is driving a financial metric, or is it simply, the math or the data that's
Reporting on it.
coming
Yeah.
in, or is AI actually doing something with that? So more to follow on that, and I didn't mean to get too far off on a sidetrack, but I would encourage everyone to go and get that FIL and think about that. It's pretty easy to say, well, I'm not 30 billion, I'm below that, so I don't have anything to do. I would say that's a dangerous assumption. I would say it's a reminder that the board and the management team have a responsibility of considering risk and risk assessing, model risk in their institution at a prudent and appropriate way to the risk profile of that institution. So that's probably the easiest way I can sort of cover my
Yeah.
bases there.
Although we don't want to assume that there won't be a lot of trickle down in that perspective. What you just said, I had a flashback to the beginning of stress testing, right? Where the first thing they did was come out and say, all this stress testing we're talking about, this DFAST type stress testing, is only applicable to institutions over $10 billion in assets. So you don't have to worry about it if you're smaller. And then John Lyons and others pretty soon afterwards immediately started mentioning, but by the way, every institution should be doing things like this in some extent. And while certainly not all the people on this call, the community banks have been felt the need to do holistic credit stress testing on their portfolios. I'm sure some of you on the call have, and that's why we built the tool that we actually have for credit stress testing. Because while excluded from the requirement, the trickle down is real.
Absolutely. And so, just for help to the CFOs and the controllers, I think that this opens up the opportunity for you to relook at how often do I need to do model validation type reviews? Is it required to do that every year, or could that be rotated on a, every other year or something like that? So there's an opportunity there to revisit that. There is the emphasis on the responsibility that management cannot delegate to the vendor, um, data integrity, that the assumptions used are approved and properly input, that they're actually in there, and then the output controls. So if you will, any model that you use, if it's the box in the middle, you're still responsible for data input, the assumptions, and the output controls. So I would consider that in the same way I consider any kind of internal control. What's the risk assessment around that? What should we be doing about periodically looking that? It calls into question, how about back testing? How often are we doing that? If you change any of your rotation cycles, please change your policy so that you are not in violation of your own policy. So those are some things there that I would be thinking about as I read that FIL. And then, of course, everything is subject to the judgment of your examiner in charge.
And, well, I think it just brings up a broader issue too, just with AI, right? That I mean, there's a million issues, but again, I mean, banks are gonna, if they don't already have one, will need to have an AI policy for both just usage in the bank, but then how it interacts or and plays with all of these different aspects of the bank. And so we're probably at the very beginning of of all of this and talking about AI policies because it's obviously going to begin to just be a larger presence throughout the institution. And I know we just concluded our OCC exam, and and that was one of the things we had to refresh was an AI policy, and it was speaking to which of our solutions or models or anything we're using when the bank uses it. How's the bank internally using it? What what do employees have? So it's going to be a pretty broad topic.
And there's been some interesting speakers recently on AI that have attempted in some way to calculate what is the productivity gain of AI against the cost, how much we're spending to develop these tools, and then what do we expect? What is our expectation about accuracy when we use AI? And some of those are a little bit scary because you see a range of estimates of accuracy between 50% accurate to 80% accurate. I heard one speaker say, so how many of you in the audience raise your hand if your boss would be happy with picking up a few hours of productivity as long as you're 80% accurate? And so sort of, I have no idea how they got those numbers. So please, I don't know. But it does beg the question as we use AI, what are our controls over the accuracy of that data, especially to the extent it's driving our expectations. So
Absolutely.
switch,
Absolutely.
switching over to economic factors, we certainly, and y'all had some great conferences here recently on your industry update and on your credit update. So certainly we're watching the credit matrices go a little bit sideways on us. And so we're kind of watching what we expect on the credit cycle. There's a fair bit of concern about oil prices due to global affairs. And once oil prices go up, they tend to push inflation in other areas like plastics and other things. And once those costs go up, businesses try to push that. So, all of these tend to be inflationary. I don't know how Chairman Warsh is going to be able to do with his supposed mandate to lower rates, because it sure looks like everything is pointing to higher rates. So to that extent, we have to consider the impact on our credit borrowers. Will they be able to sustain that? Where are we in inflation? What will that do to the economy? So all of those things are going to adjust our economic factors. And of course, fortunately, through quick analytics and other tools, we have great tools to be able to look at peer analysis and watch those trends. And so really be careful right now to be going slow and on a quarterly basis saying, have things changed enough that I need to look at any kind of a change? Office space has been amazingly resilient, except in very large urban markets. So we have not seen the downturn. The area that seems to be the most stressed right now are in multifamily properties. And so, I would be careful in looking at my layers or my components of loan portfolio and trying to consider each one of those given the uncertainty that's going on right now. Steve or Sean, you agree or disagree with that one?
I have a follow-up thought, Paul, or question for you. We've had some questions come in recently about I think I would use the word materiality when it comes to
Yep.
qualitative factors changes, especially
Yep.
in the economic from the economics perspective. Do you see banks typically when they're evaluating or reevaluating Q factors that come from external or economic type developments, do they have some sort of a mathematical formula where if these economic factors change, no matter how much or how little they change, it has a certain amount of correlational effect on Q factors, and so if this is down 2 basis points, this could connect to 1 basis point? Or do you typically see more of a, not eyeballing it, but more of a kind of, well, as long as it's not a material change, if it hasn't crossed some threshold of big, worse, better or worse, right, more or less risk, then we're just going to leave it as is. What do you typically see there?
So this is where the FIL that I was talking about really applies. I think the regulators are understanding that the largest of the institutions are using very complex models, and they are truly modeling where the model has embedded a calculation that says if unemployment goes up this, it directly moves basis points this. But I would say that most community banks are using more judgment. And as you said, we don't exactly know when unemployment goes up or down 15 basis points, what exactly is the impact on my historical cost ratio, my historical cost loss factor. So in that sense, we're stepping back and we're using that concept of directional consistency. So if we see the economy having more uncertainty and we see our peer group and maybe our credit metrics going more adverse, then you kind of have to step back and say, if my loss coverage to my portfolio hasn't changed, am I kidding myself? Do I need to do some provisioning? I would probably guess that a lot of the reason for the loss reserve to go down in the industry for June 30th was more of loan growth being very, very fast, and we just didn't catch up the provisioning. So the growth was perhaps a little surprising to us. But if you combine that factor and having more credit risk in the industry, then you better really pay attention to your level of provisioning and your level of coverage for the reserve. So I don't know how to answer that precisely, Steve. I do know that the very large, very complex models have baked in even AI tools that are trying to measure that.
Yeah.
I would encourage people, the fact that you're doing the coffee talk is great for CFOs to hear what other CFOs are thinking. That's a great opportunity. And then using peer analysis, because I'm not comfortable at a community bank level, if I was the CFO, to be able to predict what GDP changes in a basis point or unemployment changes in a basis point are actually going to affect my charge-off
Yeah.
ratio.
Yeah. I mean,
Very
direct
difficult.
mathematical correlation, even at a certain sensitivity level, suggests that there aren't 5,000 other factors, at play. And typically we see it's a lot of, it's a more kind of a butterfly effect situation where if you're going to say, if GDP goes up or unemployment goes up 15 basis points and we're, half as sensitive to that, then ours are going to go up 7 basis points. You think you're being more specific and accurate, but you're opening up a large can of worms as to exactly how did you decide of that level of sensitivity to that particular economic metric, and can you prove that historically?
Yeah. And at the end of the day, we're trying to be prudent in risk management, but we need to recognize we're trying to predict the future.
Yeah.
So, we it's difficult to do that, at least for me, Sean, probably easy for you.
That it's very difficult. I think it relates to a couple of the questions we had in the chat, around, is there historical data on these drivers, regarding economic factors that we can use, to map them back to the rating, to trigger a change. And I think to your point about being directionally consistent or accurate, I think is the best you can do. Because I mean, we've literally had this at our last two board meetings for our bank, pretty candid discussion around past dues are higher. Um, and so again, all things being equal, you say, hey, we got to feel like things are getting worse. On the other hand, there's, uh, when you look at the credits, we're looking at the collateral and how they're supported, and we're thinking, okay, yeah, there's maybe some variances, or maybe it's just some internal administrative things, but it doesn't feel like there's any risk for loss, and so you have this back and forth on where the reserve should be, and a large part of it wants to keep provisioning. There's a smaller percentage in the board who says, no, we don't need to provision. Where these are explainable and understandable, and so I do think it I personally just believe, right, if you're using economic metrics, and I would add, we have added a lot more local economic metrics that we try to develop, regarding when looking in terms of unemployment and just different things. We look at them nationally and at the state level, but then we most importantly look at them at the local level, as best we can to kind of give a better and closer feel to that. But it is. I mean, I think that the best you can do is try to be directionally accurate, because it is a never-ending back and forth volley of where those Q factors should be.
I can
So
give you two specific examples where you would think that you could go back and historically prove a relationship, and it changed. At the beginning of my career, when we got into adverse credit cycles, there was a general assumption, and it was supported in data, that the last thing that a consumer would go late on is his house payment. There was, evidence in the data that that anybody would do anything to not foreclose on their house. After you roll forward through our most recent banking crisis, we realized, especially through that crisis and then at COVID, that the last thing a customer will go late on is the car payment, because they have to keep their job. They need to get the kids to wherever. And at that same time, um, because of changes in legal foreclosure environment and so forth, banks had to work through a longer process so people could go more delinquent and not make their house payment for a longer period of time before they were actually kicked out. And so we saw a shift in sort of the priority at which consumers would use their limited amount of resources to pay which debt. And so to that, for that, that's just an example. That's why we look at individual layers of the loan portfolio and say, hey, um, for automotive loans, these are the economic factors that drive that. For residential, for office space, for hotel, each one of those areas has a slightly different behavior pattern, but it's beyond my intelligence to be able to exactly predict what that economic factor will have on my loss rate. That's just an example. Steve, did I cut you off? I'm sorry.
No, no, no. I was just going to say, if anyone on the call has got this completely figured out and buttoned up, please shoot us a line. We'd love to talk with you.
Yeah, yeah, yeah. I'm going to turn my stock portfolio over to them too, because if they can tell the future, that's per that's
Yep.
that's perfect. We can probably move on. I think we've beat this to death. I'm sorry.
Yeah, Harry, I hope we kind of touched on those. I think the bottom line is there's not really any, necessarily specific triggers or data mapping back, to help on those. I know this is a challenge for a lot of banks when you don't have any historical losses and you're trying to build and substantiate some reserves, in your ACL. But it's beauty is in the eye of the beholder, and so a lot of times it is just a historical relationship with your auditors and your examiners about where your level should be. And ultimately, I feel like, no matter what situation is, if they're comfortable with that, that's the game we're solving to. So
Yeah, and I mean, it's a pretty common challenge that many of you in the industry, see is especially with a complete lack of any significant long-term historical losses, you're being told you need to keep a reserve of X anyway, and then they're coming and asking you to justify the number that you've gotten to explicitly because they told you needed to get to it when it has never been justified, at least over the last 40 years for a lot of you. It's never been justified from the actual loss experience that you've seen over any reasonable historical period.
yeah.
Well, and unfortunately, we sat in a CFO group talking about CECL this past week, and several of the CFOs said, well, we did everything that we thought we could during the exam. The examination team said, well, we think there might be something wrong there. We don't think the reserve level is resulting in what we expect. And they asked, well, where do you expect it to be? And they go, I don't know, but there's probably something wrong. And at
Mhm.
some point, as they made adjustments, the examination team said, yeah, that looks like you're doing the modeling right, which really meant you've gotten to the reserve coverage.
We've
Yeah.
been playing the same game with a slightly
So
different set
that's
of rules for forever. We had a Midwestern bank I talked to last week. I did the math for them, and we were having this exact conversation. The bank is 104 years old. They were founded in 1922. And if you add up all of the losses they've had on their entire portfolio over the last 104 years, aggregate, it's less than 1% of their current portfolio. So they haven't aggregated 1% of losses in 100-year period, yet they're being required to have a 1% plus 1% loan loss reserve. So, well, that's approximately infinity years worth of losses for our institution, and yet they're still being asked to justify, the level. So that's an extreme example, but they're out there.
Yeah, I mean, so bottom line, right, is whatever historically has kind of worked I think that's different for every bank.
Yeah,
But
yeah.
as Paul has said many times, right, I mean, if you're in the 1.25 or 1.5, I mean, you're going to probably keep everybody happy.
Yeah.
Yeah, if I had to do it with nothing but a sheet of paper, I would probably say I'll take my whole loan portfolio and take the whole pass part, the non-impaired, any problems loans, and I would use 1 to 1.5. And then I would calculate the specific reserve, if you will, that I thought was needed for all the impaired or problem loans and add those two together. And that would be sort of my target reserve level. But nobody, please, no one can quote me on that. Okay.
Although the
Just,
math,
it's just the
the
old guy.
statistical history backs that up relatively closely. If you were to look at the from all the users that we have using the CECL solver tool, if you look at the level of reserves on the pooled loans, right, the collectively assessed loans, and then compare that, what percentage of a total reserve is coming from what is now considered the collectively assessed versus the individually assessed? And what we've been finding is about 85% has been from 85 to 90% of the total reserve has been coming from collectively assessed loans, and the other 10 to 15% has been coming from the individually assessed. So if you had a 0.25% loan loss reserve, I'd say you'd have between 1 and 1.1% on your past loans, and about 0.1 to 0.2% of the whole portfolio on your individually assessed, just as a ballpark.
But I mean, as we talk about that, please remember that would not have been sufficient as we worked through 2008, 9, and 10 and other banking
Right,
crises.
certainly not.
So however comfortable we are right now today, that's why we're looking at the economic
Yeah.
conditions of our market and saying, how am I doing not only economically, but how's my underwriting doing? And have I shifted anything? Or we have a new management team that's taken a little bit more risk. We have to make those adjustments. So we're looking very, very long-term
Mhm.
averages, but that's not your job as a CFO. It's to consider how are we in an unusual cycle right now. So Steve, I
We,
hope I'm
we
not
just had
taking too much time. We can move on
no.
if
No, that's it. Go
We just had a,
ahead. Go ahead.
we just had a question again to kind of restate the percentage against the pool versus the individually assessed. How we were thinking about that.
you're talking about
Oh,
me.
sure. So
I
this
think
is
both of you. Yeah, yeah.
yeah, the numbers that I threw out there that are rounded numbers, and it hasn't been in the last couple of weeks that I looked at it. We found approximately 85 to 90% of the total loan loss reserve, or the ACL, has been coming from collectively assessed or pass pool, if you want to equate those two concepts, and about 10, the remaining 10 to 15% of the total reserve been coming from the individually assessed loans. Of course, there isn't even a perfect definition of what loans should be individually assessed. So there is a wide
Right.
range within that. I'm talking broad community bank industry averages here. But if you've got yeah, if half of your reserve is coming from the individually assessed loans and half is coming from the collectively assessed ones, you have a uncommon situation going on.
Uh, Paul, you said right, like if you're using, one somewhere between 1 and 1.5, and then plus your kind of your individually assessed, right? That's probably for most banks probably going to get them to kind of where their comfort level is as well. So
Well, I mean, I do wonder if people that have been in the industry a long time aren't using something like that in the back of their head to determine whether the reserve coverage at the end of the analysis is reasonable or not. Is they're kind of saying for a long, long time, 1 to 1.5% has been pretty good on our pass, unless there's something unusual in your portfolio or your portfolio is skewed toward credit cards or automotive or something unusual. Um, and I
But,
would
but
point out that, if you have a higher level of CRE, you're going over the guidance of 100, 300, you might need a higher percentage in your reserve, just like the same with credit cards and automotive. The loss rates are generally a little bit higher in those areas.
yeah,
but everyone's been seeing something very different in their individually, since everyone's individually assessed portfolio is a unique snowflake and they look very different from each other. It's not just the percentage of your loans that you've decided to split off and individually assess. It's about collateral valuation. So many times we see the loans that have the most hair on them, a lot of times have less reserve than the general pool, because there's no expectation of loss because the collateral value is
Right.
twice what the loan Those obviously all play into the reserve that you have on your specific or individually assessed loans versus the general pool. And you do get some backwards kind of situations where you find you have less reserve on the individual assessments just because you're doing it based on collateral and you have, excellent collateral values in that particular pool.
Absolutely.
Well, that was a good discussion. So we kind of talked about how that impacts your approach, but Paul, if you want to continue on the checklist here for the end of the year and into
Yeah.
next year.
Yeah, and this hasn't significantly changed, except perhaps that those first two, we are seeing more. I guess we're expecting more changes in economic conditions. And so, again, going back to there's certain uncertainty, I would be having discussions among the management team and with the board that we may need to look at the CECL provisioning and the calculations and the assumptions differently. And also, perhaps if you are just using national and state, you might want to consider, is your local market, is that a good proxy for the geographic markets you're actually serving? So some of you are maybe perhaps very small and your local economy doesn't even match what your state's doing. So I would be having conversations about what's the best approach we should have there. And then we continue to see, loan participations, purchase of lending to non-financial institutions. And so we are starting to see, some sort of unusual loan components. And so I would be making sure that I treat those a little bit separately and make sure that we're appropriately treating those from a risk weighting point of view. And then we are, for the last couple of years, we've been expecting that the credit cycle will turn and we'll start to see some charge-offs. To the extent we actually see those charge-offs, we would expect to see a shift from the qualitative and quantitative factors. So a little bit more emphasis on the historical and a little bit less on the assumptions. So, you don't want to tell the board we've put these assumptions in place and they're never going to change. And then our historical actually starts showing the effect of those assumptions. And so if we hit the bottom there and we're going to go up, we want to see those economic factors to change. So it's going to, we've talked about this so long now, but at some point the credit cycle turns. And so we actually see charge-offs. And so at that point, we need to reevaluate our qualitative assumptions, if that makes sense. And I think there's two more points on the next slide, I believe, if I remember right. And those are just, I'm a great advocate for using peer analysis. I don't want to be at the front of the herd or the back of the herd. So very, very careful about that. And the regulatory messaging, I would point you back to that FIL, and then I would be watching to see what happens with AI and how they incorporate that. But I do believe that is a regulatory statement that says we're going to spend more time and resources in larger banks with larger, more complex models and less time on smaller banks with simpler models. But the expectation is that management will not lose sight of the fact that they are responsible for risk assessment and prudent controls around the modeling area. And again, we've said this a couple of times, examiners and auditors are getting more and more training on model validation and how models work. And so, don't expect them to say, you got a model? Yep, good.
Yeah.
They're going to say, you got a model? Show me.
Yeah.
Show me everything.
And I think to your point around peer analysis, right? I think I'm in the same boat with you, Paul. I'm a huge fan of peer analysis, and again, both at a larger state and UBPR level, but I do like local levels too because again, if credit issues are happening in your community, they may not be happening to your bank, but they're happening to others. It still should, raise our eyebrows a bit just to see what's happening and if it's something that's, potentially going to spread to us, or if it's just, the other banks in your area. But it is still, again, a good indication of what's happening in your local market. So, large and small peer groups, or local and larger peer groups in conjunction, work well together.
Yeah, and I'll go. I think is I'll go through the rest of my stuff really quickly here because this is a much more interesting conversation than what I had planned to talk about anyway. But I would say I'm seeing some more comments in the chat, which is great. Something that I've been working on here for a while that I'm not sure exactly when it would show up for people in Call Report Insights, but we are aware and we've had lots of interest and questions around tying Q factors and tying loss expectations to economic changes in economic trends over time, and even if it is sketchy or somewhat correlational at best, but having some sort of modeling and math around that to help justify those Q factors. And there's a couple tools that we're working on that might be able to help you guys see which economic trends have historically had the most correlation with your historical losses and past dues and problem loans. And if you were to project that moving forward, this is how it might look. And so we've been working on some tools in that arena. Hopefully in a couple of months or so, we might have something to show you guys from a beta perspective, but no promises on timing or anything there. But we're aware that that's something that more of you are asking about and would love to see, and so we're moving it up our list.
And Scott, to your chat question, you mentioned quantitative about 90% and individual assessed at 10. Our bank is 97.5 quantitative and individual assessed at 2.5. Are we good? I would say yes, right? If it's been kind of the metric that you've used internally and everyone's happy about it, I would say that's
Yeah.
fine. Right? It just
You
is
may
a
not have very
fact.
many individually assessed loans, which is fine. You may have the handful of ones you
Right.
have may be extremely well collateralized, and it just doesn't end up being, as long as you have a reasonable process with some reasonable assumptions that got you to that level, then you should be fine. All
Okay,
right.
so Steve, I don't know if you want to touch too much just on some of these enhancements, or actually kind of get into the next slides, or.
Yeah, the most recent things that we've added is some additional meat to the industry research part of our of Call Report Insights, which is very relevant to CECL and this kind of conversation. We added what we call a peer group performance matrix within industry research. I think I showed that last time, but we can very quickly show it here. First, before that, I mentioned this last time. I think most of you are aware that the UBPR went ahead and changed up their peer groups again a few months ago, and it was kind of done behind the scenes. There wasn't a whole lot of hoopla around it, but it does affect everyone who was in those kind of not the peer group 6 and above. And we had a customer just the other day who noticed some significant changes in the peer data of their stress test and of their CECL tool, and they're trying to figure out where that was coming from. And it's because they were in peer group 6. They're still in peer group 6. However, UBPR peer group 6 months ago or 5 months ago was you had to have over 3 branches and you had to be in an MSA, not just 100 to 300 million in assets. Now, the same UBPR peer group 6 is all the banks in the US between 100 and 300 million in assets. So even if your peer group didn't change, if you were part of, 7, 8, or 9, and now you're in 6, it's obvious you would know that it changed. But if you were in 6 and you're still in 6, it's still very different than it was 6 months ago. So just to remind everyone, same thing with 14 through 17 and 10 through 13. So they were just consolidating some of those peer groups, and I don't disagree with the concept behind it. It's a little bit more straightforward now. If you felt the need to recreate some of your legacy UBPR peer group, if you think the new one is too broad and you want to kind of narrow it down some, we'd be happy to have a conversation with you about how to create a more customized peer group to use for CECL Solver or any other part of Call Report Insights. Let's keep it on. What's next? Yeah, this is the peer group performance matrix that I mentioned in industry research, where you can just kind of choose the metrics that you want and see kind of Not exactly a heat map, but you get to see kind of the 10th percentile all the way to the 90th percentile of performance for whatever metrics that you're looking for. And you can choose a peer group. You can handpick all the metrics that you want and create a custom grid, so to speak. If you go to the next couple slides, I did that, and I did it for something that's relevant for CECL solver. I said, hey, what if we just took UBPR peer group six, the new peer group six, and we just looked at some asset quality trends. So we could not trends because it's not over time. We just wanted to get a map of who are what constitutes really good performance and what constitutes significantly subpar performance when it comes to past due loans or non-accrual loans by loan type for my peer group. And this gives you, I just chose a handful of segments for 30 to 89 days, a handful for non-accrual loans. And you get to see, obviously, the 10th percentile, the better performers all have no non-performing loans in that area. Median values are in the middle, and then the higher loss percentages are on the right-hand side. But it gives you a good framework to make sure that you're kind of within the range of your peers for all these different metrics that you can get pretty granular for. And you notice right now, something that Paul mentioned earlier that I'm going to allude to in a minute here again, is the coverage ratio, or the how we define that here is the loan loss reserve, or the ACL, as a percentage of non-performing loans, total non-performing loans, not 30 to 89 days, but more, 90 days plus and non-accrual and whatnot. Down to just over 200%. The median for 100 to $300 million banks in the US right now is just over 200%. And I would say it looks like somewhere between 20 and 30% of banks in the country in that asset range have less than 100% now. I'm sure Paul has some thoughts on that, but we'll see some more detail on that in just a second. So go ahead and next slide. Next slide is the same thing. I just said, well, why don't we compare this to a year ago? So all I did was I took my same grid. I just changed the date from June 30th of this year to June 30th of last year. And I'm not going to go through all the data here, but look at that coverage ratio. Second row right in the middle. It was 245% a year ago. It's now 209%. And this is for for June 30th for 100 to $300 million banks. So interesting. Next. All right, so we're going to go through these pretty quick, but I just wanted to point out a couple things on. You guys have seen this before. We updated each quarter just to get a feel for trends in credit quality. As you know, things haven't been hitting the actual charge-offs, at least not at the median level. We see it at the margins at the 75th and 90th percentile. Past due loans, we do start to see even at the median, or certainly at the 75th percentile. And we get some seasonality here. They peak at the end of the year. They come down in the first quarter, and then they do something interesting in the second quarter, up or down. And that's what we see here as well. But if we track the same period, right, the same date of each year, as opposed to trying to find linked quarter trends, we see that they're all still mostly trickling upwards. Not significantly, but there is a continued march slightly up in past due and non-accrual loans. So if you go to the next slide, we see non-accrual. Same thing here, right? In some of these, at consumer loans at the median, no non-accruals, but at the 75th percentile, we start to see that trend. So some cracks in the armor at the margins. Next slide, I believe I also did growth or charge-offs. I did. And for charge-offs, we're not even looking at median ones, because for most peer groups, the median, the 50th percentile, is a lot of zeros, right? But to look for these trends that are leading trends, we look at the 75th and the 90th percentile. So if you look at consumer loans, 90th percentile loss rates are over 2% now. Now, that's only 10% of the banks, have those, but we see that 90th percentile moving higher, which suggests, again, cracks in the margins. Next. Reserve to loans. All right. Pretty flat. Extremely flat. This is UBPR peer group 5, so the biggest one, right? All 1,200 community banks in that 300 million to a billion range. But over the last 12 quarters, 3 years, super flat. The next one, less flat. Total non-performing loans. As of June 30th of 2023, so 3 years ago, 22 basis points. Today, 44, exactly double. So we all know what the next slide is going to be, right? Yeah, the coverage ratio. And it should be about half of what it was, right? Reserves stayed the same. Non-performers doubled. Reserve coverage ratio should be halved. And it was. It has. It was in the 400% range. Now it's in the 200% range. This is a short-ish term study, though, right? This is over 3 years. And I wanted Paul's take on this. He hasn't seen this yet, so I wanted his. I saw that, and that's a big story. But let's zoom way out. Let's zoom all the way out. Go ahead. Next slide. This is reserves sent over 20 years. We know why they went up. We know why they went down. We know why the little blip happened in 2021. We know the story behind this. Next slide. Total non-performing loans. So we know what happened with the reserves. We know what happened with non-performing loans. We know 2009, 10, 11. That's no big surprise. What we didn't see is nearly that kind of bump in 2018, 19, and 20. A slight bump, but nothing like what we would have expected after you looked at what happened to reserves on the previous slide, right? So now go to the last slide. All right, this is a bit of a different take on coverage ratio. The last one I showed you, the last 3 years, it's been falling off a cliff. But if we take a 20-year look at it, are we back to what should be a long-term average, or should there be a long-term average? I'll leave the question. Paul, thoughts on this?
Yeah, you know, I think any group of examiners or analysts outside the industry is going to look at the right side of that graph and go, huh, are you provisioning enough? And again, I've already heard people say, well, I know why we had such strong earnings through the first half of the year. We just weren't provisioning enough. And so, it does beg the question, if you look at some of these and you look at some of the trends in the asset quality area, it isn't that we're falling off the cliff, but are we going in a way that should we be paying a little bit more attention? We've just come off such a long bull credit market that, we don't want to be complacent here. But some of those things will make you go, are we okay?
Yeah, I mean, I think we all can agree that obviously the current trend of coverage ratios declining can't continue forever, and shouldn't. At some point, we should expect that to bottom out. But a separate question on an absolute long-term basis, yeah, it's going down, and it's going to cross the 200% threshold at some point relatively soon here. But on an absolute basis, is 200% not enough, or is it just more so directionally? We know it can't keep declining.
Yeah, and it begs the question, we got 200% of the non-performing, but what about the loans that are performing now that would be expected to move into non-performing as, we just heard news, the federal deficit is at the highest level. Where does that presume that interest rates are going? As we have to adjust interest rates up on our borrowers, does that put more pressure? What's inflation like? What is the inflationary impact and effect on the economy of continued very, very high oil prices, and as that trickles down? So there's enough there to not be a pessimist, but to question, what do I not know? We're trying to predict the future, and should I pull the guardrail back away from the cliff, maybe a couple more feet? I don't know the answer to that.
Yeah, it's the question. Yeah, how is all that going to affect my low pass portfolio, right? Stepping out of the public realm and into the your own risk grading assessments and past due assessments that are more granular than what we see on the call reports, that what I have access to on an industry-wide basis, is an interesting question.
Because there is that, if you do have, greater stress, like Paul kind of alluded to it earlier, right? You just bring into the realm a whole lot of other issues, right? All of a sudden, like these are marks, even our collateral marks in good times or just steady times are going to be different if there is some kind of you know disruption in your local market or what have you. The collateral values probably aren't strong because now all of a sudden you may bring in borrower liquidity issues, right? And just a whole host of other issues that could make things get a whole lot more complex.
Absolutely. I just think this is a time to go slow down, and think through. Just because I use this for the last 4 or 5 quarters, is this what I need to be looking at going forward? So, again, I hope we're not coming off to be the sky is falling or overly cynical, but there is a lot of uncertainty in the economy, and we've just come off a very, very strong period of time. So I'm not as worried about our non-performing loans getting worse. I'm more concerned about our performing loans moving into non-performing, to be honest.
Yeah,
I agree with that. I agree with that.
So,
I think that's all that I had. Oh, you can just very
So
our
just
big
yeah.
proprietary database of information from all the scenarios that we've gotten from our CECL solver user customers, and we turn that back around and offer it to you guys so you can see those trends over time. And I
And
don't
again,
believe.
just not to interrupt, Steve, but just a directionally thing, right? If you look at this thing, and we always highlight if the trend's getting better, it's in green, and if it's getting red, a lot more red than we've seen historically.
Go to the next. Did I put it on the next slide here? Oh no, I didn't. I didn't.
Yeah.
Yeah.
So, again, for what it's worth, directionally, a lot more red in this than we have had, in the past. Okay. Um, we'll open it up again for any final questions. And while we're waiting for that, just a reminder, certainly request a demo. Reach out to Lauren if you want to learn more about call report insights or the exciting new developments that Steve continues to put out there. Please reach out to her. Again, Steve, you want to talk about this Insights Hub? Anything you want to share here? Just
No, I mean I think it speaks for itself here today.
yeah,
We're working on a lot of different ways of bringing this type of content to you in a way that you can get your arms around and digest. And so I encourage everyone to go and take a look at some of those topics that we've discussed there in the Insights
yeah,
Hub.
and just different articles or different things for again, hopefully improved knowledge and understanding of a variety of different topics.
Yeah,
All right, let me take one last look. I don't see any additional questions, so
I didn't see any.
certainly thank you all for joining us today. A reminder: we will send out a link to the recording and a copy of the slides. Paul and Steve, any final thoughts before we let everybody go?
no, I've enjoyed the conversation. Hope it's helpful.
Always is with you, Paul. Thank you so much. Thank you, everyone, for joining us today. Look for our next quarterly coffee talk later in the year. On behalf of Steve and Paul, thanks for joining us. Have a great weekend.
Thanks,
Thank you.
everybody.
Thanks.
Bye.